It is a mechanical
Geez,
Let's pause on that for a
grocery shelf space. The reality,
122% quarter-over-quarter.
dressed arbitrage, and massive loss. The business is failing, and the tape
Quarter to reset the baseline.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
149.6 million shares. That is the exact number of Beyond Meat shares that traded entirely off the public exchanges in just a single week, ending January 26, 2026. We are talking about roughly $100 million in value, quietly changing hands in the shadows of the market. And if we zoom out to a 12-week period, a staggering 2.59 billion shares were traded in these hidden venues. Against this backdrop of unprecedented dark pool volume and a stock sitting at historic lows, the central question emerges for us today. Does this massive off-exchange trading, coupled with a recent surge in institutional ownership, signal a calculated accumulation by smart money recognizing a turnaround? Or is it merely the mechanics of distressed debt dilution and heavy short selling, essentially masking a dying core business? I argue that the massive institutional buying and the recent debt restructuring provide the actual financial runway needed for a legitimate operational turnaround.
And I argue that this staggering off-exchange volume is driven almost entirely by distressed arbitrage and massive short interest, reflecting a fundamentally collapsing business facing insurmountable legal and financial hurdles.
To really understand the bullish perspective here, we have to look past the headline stock price. We need to examine the structural financial repair that is currently underway. In September of 2025, Beyond Meat launched a $1.15 billion convertible note exchange. What they did was successfully swap notes that were due in 2027 for new PIK notes, extending the maturity all the way out to 2030. For anyone who might not live in the bond markets every day, PIK stands for payment in kind. It basically means that instead of paying cash interest right now, the company can just add that interest onto the principal debt.
Right.
And that is the very definition of creating breathing room. It keeps cash in their pockets today. And the institutional side of the market, well, they clearly noticed this maneuver. By the third quarter of 2025, we saw a massive 222% quarter-over-quarter surge in institutional ownership.
But we have to look at what kind of ownership that actually is.
Let me just lay out the filings first, because the SEC filings tell a fascinating story here. Vanguard increased its stake to 24.5 million shares. That represents 5.4% of the entire company. We have Unprocessed Foods operating through the Ahinsa Foundation, taking a massive 12.5% stake. When you see 50 to 60% of total daily volume happening in dark pools, week after week, that represents systematic institutional accumulation at these sub-$1 levels. The market is quietly pricing in a recovery based on their new product pipeline, specifically the Beyond Tech Kitchen initiatives.
I'm sorry, but I just don't buy that. Let me tell you why. The share volume and the specific SEC filings you are pointing to are quite literally optical illusions created by extreme financial distress. That $1.15 billion debt exchange you just praised, it didn't just elegantly extend maturities. It created roughly 326 million new shares. That is catastrophic equity dilution. When you see filings from hedge funds like D.E. Shaw and Wolverine Asset Management, who filed for 18.9 million shares, by the way, they are not making long-term value investments in the future of plant-based burgers.
You really don't think they see any underlying value in the brand equity?
No, I really don't. They are engaged in convertible arbitrage. Let's break down what that actually means. These funds buy the convertible debt because it offers a yield, but to protect themselves, to hedge that position, they short the common stock. And that brings us directly to your dark pool data. The high off-exchange volume directly correlates with a reported 60% short interest of the float. 60%. These are hidden short trades backed by horrific core fundamentals. We are looking at a Q3 2025 revenue drop of 13.3% and a $112.3 million operating loss. The business is failing, and the tape merely reflects the vultures picking at the capital structure, locking in their arbitrage spreads.
That's an interesting point, though I would frame it differently. It is entirely fair to acknowledge that convertible arbitrage plays a major role in the trading tape when a debt exchange of this magnitude occurs. I will grant you that the dilution was severe. However, reducing the entirety of this multi-billion share volume simply to short selling and hedging ignores the very real net institutional inflows we are seeing.
But the inflows are intrinsically linked to the new share issuance.
Some of them, yes, but market beat data shows net institutional inflows of $38 million over the past year. You mentioned the hedge funds, the D.E. Shaws of the world, but you kind of glossed over the passive, long-only accumulations. BlackRock increased its position to 5.2 million shares. Vanguard, as I mentioned earlier, is up to 24.5 million shares. These are 13G filings. For our listeners, a 13G is a filing used by passive investors who intend to hold the stock long-term, which is completely different from a 13D filing, which is used by activists or funds making aggressive, immediate moves. Furthermore, when we analyze the alternative trading system, or ATS, venue data, which is what we mean when we say dark pools, we are seeing consistently heavy block trading without the sudden, violent price spikes usually associated with panic shorting or one-off hedging events.
I come at it from a different way. We really have to analyze the specific nature of those filings because they tell the true story of the tape. You want to talk about the 13Ds? Look at D.E. Shaw's Valence portfolios. They acquired 31.97 million shares specifically within the mechanics of the debt exchange, and then they immediately turned around and ended up retaining just 9 million shares for a 2.3% stake. This is purely financial engineering. It is not a vote of confidence in the food products.
I'm not convinced by that line of reasoning because you are looking at one specific hedge fund's behavior and applying it to a broader trend of 2.59 billion shares. The fact that billions of shares traded off exchange over 12 weeks without breaking the fundamental market structure suggests a systematic, calculated accumulation by major broker-dealers who are quietly absorbing the retail capitulation. They use dark pools precisely so they don't spook the public markets while they build their positions.
But look at the timeline of that volume. The off-exchange volumes peaked precisely when the price was cratering below the $1 mark in late 2025. When an equity is exhibiting illiquidity on the lit markets, the public exchanges, and simultaneously seeing 60% of its volume internalized or sent to ATS venues during a price collapse, that indicates aggressive offloading and systematic shorting. It is not bullish accumulation. If institutions genuinely believed in the turnaround, if Vanguard was aggressively pounding the table, you would see accumulation driving price discovery on the public exchange. Instead, we see dark pools being used to mask the sheer scale of the exit. It is prime brokers internalizing order flow from hedge funds who are utilizing those 326 million newly issued shares to execute complex short strategies.
Let's pause on that for a second. Even if we accept that a significant portion of the dark pool volume is arbitrage, you still have a company that successfully pushed its debt obligations back half a decade. That gives them time.
Time to do what, exactly? And this brings me to the reality of what Beyond Meat actually does. Pause. They sell meat alternatives, and that core business is an absolute freefall. Let's pivot away from the market plumbing and look at the actual fundamentals. In Q2 of 2025, revenue dropped 19.6%, down to $75 million. And the Q3 numbers were even bleaker. U.S. revenue was down roughly 21%. International revenue was down, pause. They posted a net loss of $110.7 million for the quarter, which included a devastating $77.4 million asset impairment charge.
Which was a necessary accounting move.
It is a reflection of lost value. Consumer fatigue is real. Premium pricing in a highly inflationary food market is completely crushing their volume. Major multinational food conglomerates are expanding their own plant-based lines and fighting for the exact same very limited grocery shelf space. The reality on the ground is so bad that Q4 revenue estimates have dropped to just $60 to $65 million. You cannot financially engineer your way out of a product that consumers have simply stopped buying at scale.
I see why you think that, but let me give you a different perspective. No one is denying that the Q3 numbers were brutal. They were hard to look at. But in corporate turnarounds, you often have to endure a quarter where management essentially clears out the closet. It is what we call a kitchen sinking event.
Kitchen sinking.
Exactly. When a company is restructuring, management will intentionally take all the bad news, all the write-downs, and lump them into one terrible quarter to reset the baseline. I view that $77.4 million write-down not as a terminal decline, but as taking the medicine now to clean up the balance sheet for the future. You mentioned the operating loss, but you really have to separate the one-time non-cash impairment from the go-forward cash burn. Management has executed aggressive cost-cutting measures, including 44 recent staff cuts and massive structural realignments, but more importantly, they are not just cutting, they are innovating.
Innovating how? By tweaking the burger recipe again?
No, by changing the distribution and product architecture entirely. Look at the top-line catalysts they've recently introduced. In October 2025, they launched the direct-to-consumer BYND Test Kitchen. They are debuting completely new protein architectures. We are talking about the fava bean-based Beyond Ground and a highly anticipated mycelium-based steak fillet. By shifting to limited-time drops and direct-to-consumer models, they bypass the congested retail freezer aisles you just mentioned. They're going straight to the most loyal consumers. Furthermore, look at their hospitality partnerships. The November 2025 nationwide rollout of the Beyond Burger IV at Hard Rock Cafes proves that major legacy hospitality brands still see massive value in partnering with the Beyond brand.
That's a compelling argument, but have you considered that a direct-to-consumer pivot in a single restaurant chain partnership cannot possibly offset the structural collapse of their broadline distribution? We are talking about replacing hundreds of millions of dollars in lost grocery retail volume with internet drops of fava beans and a mushroom steak. I mean, think about the scale. A mycelium steak drop might generate some niche internet engagement, but it does not fix a supply chain built for mass market grocery.
It proves they are agile. It proves they can develop premium products that don't rely on the legacy pea protein model that got commoditized.
But while management is busy trying to market test kitchen products online, the actual corporate entity is being swallowed alive by legal and macroeconomic headwinds. Let's talk about the liabilities that are not fully priced into the so-called turnaround. In November 2025, a court found that Beyond Meat infringed on a Veg of Philadelphia trademark regarding their marketing slogans. This resulted in an order to pay $39 million in damages. For a company with this level of cash burn, a $39 million judgment isn't a minor hurdle, it is an existential threat. Add to that the ongoing SEC-related investigations. Add to that the securities class action lawsuits filed just recently in February 2026 by Rosen Law Firm and others, which allege that investors were intentionally misled about the timeline and severity of those very write-downs you just called kitchen sinking. These legal liabilities, honestly, the defense costs alone, could completely consume whatever meager cash runway the debt exchange theoretically created.
I'm not convinced by that line of reasoning because it assumes the absolute worst-case scenario for every pending legal issue while giving zero credit for their victories in the courtroom. I will concede that a $39 million judgment is severe. Nobody wants to see that. But we must remember that it is currently under appeal. It is not an immediate cash outlay draining their reserves today, and historically, these figures are frequently reduced in appellate courts, or settled for a fraction of the headline number.
But it remains a massive liability on a fragile balance sheet.
It is a liability, but they also have assets in their legal column. You omitted that Beyond Meat recently secured a major legal victory in October 2025 during an arbitration dispute against a co-manufacturer. They are highly capable of defending themselves successfully. And regarding the class actions, let's be realistic about how the market views these. Those are standard, almost algorithmic responses by specialized law firms. Whenever a company announces a significant impairment charge that affects the stock price, a class action follows within weeks. It is practically a reflex in modern corporate law. These are legacy rearview mirror problems. The market's pricing mechanism is inherently forward-looking. At sub-$1 levels, the market has already aggressively factored in the litigation risks, the meme stock volatility, and the revenue contraction.
If the market has priced it all in,
Why is the short interest still sitting at 60%?
Because of the complex hedging strategies tied to the 2030 notes we discussed earlier. The bad news is known. It is out there in the open. What is not fully appreciated by the retail public is the runway created by pushing those debt maturities to 2030. That gives their new product architectures the time they desperately need to capture the next wave of consumer adoption.
The problem with the forward-looking pricing argument is that it completely relies on the assumption that there is a viable business model at the end of that runway. Extending debt to 2030 is mathematically meaningless if your cost of goods sold consistently outpaces your net revenue. Let's look at the margins. The Q2 gross margin was a microscopic 11.5%, and it deteriorated from there. You cannot scale a mycelium steak into profitability if you're actively losing money on the core burger product that built your entire supply chain.
They're actively fixing the cost structure. That was the whole point of the 44 staff cuts and the facility realignment.
You don't cut your way to growth. And when we tie this all back to the tape, the market structure tells us exactly what the institutional players actually think. The 60% short interest is not a mistake. The billions of shares traded off exchange are not a secret accumulation by a phantom majority who believe in fava beans.
Pause. It is a mechanical unwinding. It is prime brokers internalizing order flow. If Vanguard or BlackRock's passive index rebalancing is the strongest bull case for the equity, then the fundamental thesis is incredibly weak. They hold those shares because Beyond Meat is still in the indices they track, not because their analysts are pounding the table on a remarkable corporate turnaround. That's an interesting point, though. I would frame it differently. To summarize my position in light of our discussion today, I maintain that while the fundamentals undeniably look distressed on paper right now, the underlying mechanics of the market suggest a very different long-term reality. What fascinates me here isn't just the stock price, it's the plumbing of the market. We are witnessing billions of shares traded off exchange and major institutional funds building massive 5% to 12.5% stakes. You do not see a 222% quarter-over-quarter surge in institutional ownership without deep, algorithmic conviction that the downside is capped and the upside is entirely mispriced. Yes, the $1.15 billion debt restructuring was painful, and I agreed with you that the dilution was severe. But it achieved its primary goal, survival.
Clear the balance sheet through necessary impairment charges and bring innovative products like the Beyond Test Kitchen Pipeline directly to consumers. The foundation for recovery is quietly being laid right in front of us, even if it is currently obscured by arbitrage volume.
And to summarize my view, I stand firmly by the evidence that the staggering trading volume we are seeing is nothing more than a mirage. It is the mechanical byproduct of a desperate $1.15 billion convertible debt exchange, heavily diluted by 326 million new shares and weighed down by a massive 60% short interest of the float. All the financial engineering in the world cannot fix a core business that is plagued by double-digit shrinking revenues, devastating $77 million asset impairments, and undeniable consumer fatigue in the grocery aisle. When you add the mounting multi-million-dollar legal judgment and SEC scrutiny to a fundamentally broken margin profile, the thesis becomes entirely clear. The dark pool activity is not smart money quietly accumulating for a turnaround. It is the smart money dynamically hedging the distress of a collapsing business model.
This divergence between Beyond Meat's trading tape and its actual balance sheet remains one of the most fascinating market structure case studies we've seen this year. It really highlights the immense value of looking past headline share volumes to truly understand the complex mechanics of distressed debt and institutional order flow.
Exactly. And it suggests that anyone following this space needs to dig into the underlying SEC 13D and 13G filings and examine the dark pool dynamics for themselves. There is so much more to explore in this material to draw your own conclusions about the ultimate fate of this plant-based pioneer.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!